Here's something that surprises almost every client I work with. The people most likely to get hit with an unexpected tax bill in retirement aren't the ones who are careless. They're the ones who save the most. The bigger your 401k, the more exposure you have to the 4 traps in the tax code that most advisors don't flag until it's too late to fix them. I'm Tim Gardner, Wealth Manager with Chatham Wealth Management. I see these hit real people, prepared people, every week. Today, we're going to cover the traps that hit you even before you retire, the ones tied to Medicare, to Social Security, and the one that nobody talks about, but the one that married couples especially cannot afford to ignore. By the end, you'll know exactly what each one is and what you can do about it before it costs you. Let me start with the one that's hitting people right now. Not in retirement, but today, while they're still working. I got a call in January from a client. I'll call him Mark. He's 58, a senior director, and makes about $185,000 a year. For the last 15 years, he's been maxing out his 401k on autopilot, including catch-up contributions. Smart guy, disciplined saver. He was frustrated. He said, "Tim, I haven't changed anything about my lifestyle. My take-home pay just dropped by $250 a month. My HR person says it's because my catch-up is now Roth by law. Why am I paying more in taxes just to save the same amount?" Hey, I get it. It does feel like a phantom tax hike. You didn't do anything different and your paycheck, it's a little bit smaller. But once you see what's actually happening, this will change things completely. Back in 2025, Mark's $8,000 catch-up contribution was pre-tax, and depending upon his bracket situation, that likely saved him somewhere between $1,500 and $2,000 in taxes a year. In 2026, the law says the catch-up contribution must go into a Roth. Now, he's still saving the same $8,000, but the deduction is gone. If you spread that out over 12 months, that's exactly why the paycheck feels a little lighter. So I asked Mark a question. What if I told you that when you retire, your tax bracket might jump? Would you rather pay tax now or tax later? That's the real choice. You pay wholesale today or retail tomorrow. And the answer matters more than most people realize because the gap between those two options could be worth tens of thousands of dollars over a 20-year retirement. A Roth dollar in retirement is worth more than a traditional dollar because it's already been taxed. When Mark pulls money from his Roth in retirement, the IRS isn't waiting at the door with its hand out. Every dollar he's grown in that account is his to keep. With a traditional account, the IRS gets its cut first, and if taxes go up by then, that cut could be bigger than what you'd pay today. So in reality, that mandate actually forced him to do something he was afraid to do on his own, start building a tax-free bucket. And if you're between 60 and 63, pay close attention. Your catch-up limit in 2026 is $11,250, not $8,000. That's an even bigger tax-free growth opportunity sitting right in front of you. Now, to avoid this, you want to adjust your budget now to account for a lighter paycheck. And whatever you do, don't fight the mandate. Use it in your favor. If you like information that gets you kind of ahead of the curve like this, go ahead and subscribe to my newsletter. Every week I put out information like this directly into your inbox. The next trap can cost you over $2,000 for going $1 over a line that almost no one knows exists. Most people assume that Medicare premiums are basically fixed. You turn 65, you pay your Part B premium, you're done. That's not how it works. Medicare premiums are actually income-based. And unlike normal tax brackets, where only $1 above that line is taxed at the higher rate, Medicare uses a cliff. Go $1 over the threshold and your entire premium jumps for the entire year. $1, one whole year. And here's what makes this worse than it sounds. I had a client who sold some stock to cover his daughter's last year of college tuition. One transaction. Totally reasonable thing to do. It was kind of a knee-jerk reaction. He didn't think twice about it. But that sale pushed his income over the IRMAA threshold, and it cost him $2,000 in extra Medicare premiums. And here's the part that really stings. He doesn't get the bill right away. Medicare uses a 2-year look-back. That means your premiums this year are based upon your income from 2 years ago. So he made what felt like a routine decision. 1 year, got hit with the cost of a knee replacement 2 years later. The pain showed up long after he had forgotten about the transaction that even caused it. For 2026, the threshold is $109,000 for single filers, $218,000 for married couples filing jointly. One extra withdrawal, one December distribution you didn't think twice about, and you're over the cliff. And you won't feel it for 2 years from now. A small overage can cost a couple more than $2,300 a year in extra premium. That's the hotel checkout bill that nobody warned you about at check-in, except it arrives 2 years after you've checked out. Here are 2 moves to avoid that. First, qualified charitable distributions. If you're charitably inclined, you can give directly from your IRA. It counts towards your RMD, or required minimum distribution, but doesn't hit your modified adjusted gross income. Second, withdraw from Roth accounts instead of pre-tax accounts when you're close to the threshold. Roth withdrawals don't count towards your MAGI. Stay $1 under the cliff and you keep $2,300. Hey, before I move on to trap number 3, drop a comment below. What's your biggest concern about the first couple years of retirement? I read every one. The next trap creates an effective tax rate well above 40% for people sitting in the 22% tax bracket, and most of them have no idea what's happening. Most people assume their Social Security is either tax-free or mostly tax-free. The IRS has a very different opinion on that, because up to 85% of your Social Security benefit can be included into your taxable income, depending upon your other income. That 85% gets taxed at your ordinary income rate. Most people hear that and think, okay, I'm fine, 22% tax bracket, that's manageable. But that's not even the dangerous part. The dangerous part is what happens when you're in that phase-in range, the income window where Social Security is still becoming taxable. Now, in that zone, for every dollar you pull from your 401k, you could potentially see as much as $1.85 of your income becoming taxable. Your 401k withdrawal doesn't just add to your income, it drags more of your Social Security into the taxable column at the exact same time. That's the tax torpedo, and it's aimed right at middle-income retirees who did everything right, saved consistently, and now find themselves getting hit harder than most people who earned more. Not because they're wealthy, but because this is how these two systems interact. The result is that people sitting in what they think is the 22% tax bracket can see their effective marginal rate climb significantly higher with those withdrawals. Think of it kind of like a minibar chart. You didn't think you'd touch it, but once you do, the math gets ugly real fast. I got 2 moves to help you avoid it. First, delay Social Security to age 70 if you can. Every year you wait, your benefit grows by 8%, and you shrink the window where the torpedo can hit. Second, do Roth conversions, especially in your bridge years, the gap between when you retire and when you start taking Social Security. Convert that pre-tax money while your income is lower so your future taxable income is smaller when the torpedo would otherwise detonate. Now, the trap I want to cover last is the one that takes the longest to fix, which is exactly why it can't wait. Nobody told me when I got into this industry years ago that it would keep me up at night worried about other people's money. This one does. When I sit down with a married couple to talk about retirement planning, there's almost always that moment in the meeting where the conversation shifts. We've gone through what they're doing, what the plan looks like, and what we've already got in place. And then one of them looks to the other and asks the question I almost come to expect. What happens to the one who's left behind? That's the widow's penalty. And that's not a market risk, it's not a health risk, it's a tax risk hiding inside of a life event that no one plans for. You see, a few months ago, I got a call from a longtime client. She wanted to schedule a call as soon as possible. And when a client calls wanting to talk right away, it's rarely good news. And it certainly wasn't. You see, her brother-in-law had passed away the year before. Her sister's tax bill had gone through the roof. Same income as when they were married. RMD still coming in, Social Security still coming in. But now she was filing as a single taxpayer. The brackets were half as wide overnight. What used to be manageable was suddenly pushing her deeper into territory she never expected. Now, my client and her husband felt terrible for her sister. But they looked at each other and said, we don't want to end up in the same spot. You see, when a spouse passes away, the filing status flips from married, filing jointly, to single. Barely changes, but the single brackets are narrower. And depending upon your income level, what felt manageable as a couple can now push the surviving spouse into a significantly higher tax bracket overnight. Now, here's where the story has a different ending than her sister's. My clients weren't starting from zero. We had already begun doing some Roth conversions as a part of their plan. After the call, we stepped up the pace, and the relief on their faces when they realized they were already moving in the right direction was something I simply won't forget. This trap is completely fixable, but only while both spouses are alive and you still have the wide married filing jointly brackets to work with. So how do we avoid this? Aggressive Roth conversions now. The goal is to shrink those pre-tax accounts, the 401k, the traditional IRA, that are going to drive those RMDs later. Every dollar you convert today is one fewer dollar creating a tax problem for your surviving spouse down the road. The window to fix this doesn't stay open forever. Every single one of these traps has something in common. They're invisible until they become too late to fix them. It's like the hotel room rate that looked fine when you booked it. It's always the checkout that gets you. Knowing these traps exist is only step one. But step one isn't enough because the trap doesn't care whether you know about it or not. What actually protects you is knowing your specific numbers, your MAGI, your bracket, your RMD trajectory, and how all this fits together. That's exactly what I walk through in the next video, Retirement Income Fixes That Change Everything. It covers tax bracket arbitrage, tax efficiency, withdrawal sequencing, and how to manage your MAGI so you stay on the right side of the IRMAA cliff we talked about earlier. Hey, if this video raised questions about your own situation, that one gives you the framework to actually answer them. It's linked right up here. And if you want someone to actually look at your specific numbers, grab some time on my calendar. Links down in the description too. And be sure, if you like information like this coming to your inbox on a weekly basis, feel free to subscribe to my newsletter. Links down below. I'm Tim Gardner, and I will see you in the next video.